0.8% versus April. It was an expectation of a drop of about 0.6% overall. Now, one more thing to kind of key in on, it's the
Good morning, everybody. It is the day after July 4th, Independence Day. It is a shortened week in the stock market, but there's no shortage of news and developments and happening. Lots of stuff happening in tech, lots of stuff happening in global energy. Let me show you
versus
some things
April,
here. Okay,
down
so
about
first
0.7 was the
let's have a
expectation
look
there.
at,
So overall, the markets seem to be kind of taking some
right
of these.
Now, they had some interesting stuff on CNBC. You can see how the markets are doing today, though. Kind of flat, honestly. Started much more down than it is right now.
Overnight, with the private sector, kind of private looks at some of these, Carl.
They are talking about some of the economic indicators that are being released this week. Right now, factory orders, manufacturing across America is not as strong as they expected. They expected it to be about twice as strong.
Mike, and as for here, I mean, coming on the heels of ISM on Monday, where you got prices paid down in the low 40s.
And the manufacturing side still is not coming around in terms of showing too much of a convincing bottoming process. Interestingly enough, industrial stocks been very strong, been feeding off of a lot of other dynamics. It has partly been aerospace and defense. Transports actually have been also on the stronger side, but it's still this kind of sloppy give and take type data flow out of the manufacturing.
I want to show you a few interesting articles that I got put together this week. Let's have a look here. First things first, let's just see. Yes, okay, so everything's still down. Let me show you an interesting ETF for those of you who like to just like throw everything at the wall and take on a ton of risk. A 3x leveraged index that just follows the FANG stocks. Pretty wild. It's up like 300% since January. So for those of you who like to go crazy, interesting thing for you to consider there. Okay. First, you may have missed it because it was July 4th weekend, but on Monday, July 3rd, Saudi Arabia and Russia announced another 1.5 million barrel per day of crude oil production cuts. It also happens to come just as crude oil prices fall into the $67 to $70 range that the U.S. wants to refill the strategic reserve. This is the third time we've seen OPEC do this. Are energy resources being weaponized? The obvious answer is yes, because energy has always been an easy weapon for geopolitics. You know, one of the things that was a very interesting comment, this guy, in fact, I love how Twitter is doing this. I don't know if they changed their algorithms on how people can comment, but there are I've noticed that since Elon Musk made a lot of changes, there are a lot better comments on Twitter. This guy here says, so much of the recent fall in energy prices seems to correlate with the draining of the SPR. It will be interesting to see how the price of oil reacts when that draining ends, especially given these oil production cuts. Well, Mr. David Summers, I'm not sure that the SPR draining is going to end. We've drained half of it in just over a year. We could definitely drain the rest of it before the 2024 election if we wanted to, but honestly, time will tell. To build on this, though, here is a little more in-depth about what the oil cuts of OPEC say. One, Saudi Arabia is going to extend 1 million barrels per day of production cuts through August. Two, Russia will cut about 500,000 barrels per day production in August. And then the Dubai, UAE, and OPEC Plus say they want supply and demand, quote, balance in oil markets. So what does that mean, balance? Well, that's how all these guys in the Mideast make the most of their money. And if other countries like the US, Canada, wherever are having somewhat, even just a tiny amount of leverage, that's what they want. They want balance. So they say, fine, you guys aren't needing this much oil, we'll just cut it. They want to keep their golden goose laying eggs, and I can't blame them. However, here there's a great comment on this topic that said, gentle reminder, Alberta, your friendly neighbor on Montana's border, has the third largest oil reserve in the world. And then this guy comments, don't forget, the oil field in Arizona and Texas is even larger, but can't drill because that retarded leadership. So don't be offended. It's the comment section, you guys. And then, another guy says, if only we had some sort of pipeline. And then there was somewhere else talking about how much others. But I mean, we've got this situation here where Saudi and Russia are cutting their output in oil, and it's costing us. And really, we're doing it to ourselves, because everybody who has half a brain and understands this stuff knows that in the United States and Canada, we have so much oil and liquid natural gas and all of that stuff, but we're just not. In fact, we're not allowing ourselves to drill it. Um, there was a very successful, billionaire hedge fund investor that everybody listens to, and I don't remember who, but the guy said people forget this stuff's actually kind of worth more in the ground right now. So, maybe the next administration, or whenever the time is right, they just open the floodgates and allow this to be allow this to be pushed out like crazy. But that's not yet. So let's see how those oil stocks are doing though. Let's see. Let's just look at, actually, let's just look here at the heat map, and we'll look at just the 1 week. So if we zoom in on energy over here, not, let's see. I mean, heck, that's some really good numbers there for just less than a week. Yeah. Yeah. The oil and gas industry is loving this news, because that's just going to be more and more profits for them. I mean, look at this. This is just in a few days, with half a week being shut down. You're seeing, gosh, who's that? Is that VAL? Is that Valero? Wow, up 10%. Who else is up a lot? CHX. I don't recognize that one. TDW. I probably should, but I don't recognize them. Up 9% essentially. Yeah, wow, these are some big numbers. So you guys out there who are owning energy, it looks really attractive right now to be owning energy. What's the SLNG? Gosh, who is SLNG? Up 10% just on this news. So as you can see, the oil and gas industry is loving this kind of geopolitical drama. This is just today. Today's, as you can see, kind of a down day. But interesting. We'll see how this continues to develop. Okay, so as we continue through, let me close that. So this was an interesting development that somebody actually wrote about, and I didn't even consider this really until I read this. This guy says, "Forget quantitative tightening. The Fed will double its balance sheet to over 16 trillion, boosting stocks." So after that whole debt ceiling drama that happened about a month ago, of course, as always, I had quite a few people say like, "Hey, what do you think about this? Is this the real deal?" And I said, "No, they do this every single time." I used to think it was the real deal until I started realizing a pattern that every single, every year or 2 years when they have this debate, they wait until truly the week of, and both sides, all politicians shout, they go on TV, they give a rally's cry, and then boom, they all fold at the last second. What was unique about this one was that they said there is no spending limit. The ceiling is suspended until what, 2025 or 2026, something like that, for years, something like that. And the amount of money committed for spending has already increased by like how many billions? Tens of billions in just like a month, hundreds of billions in a month. But here's what the guy says. Here's this article. It says, in fact, it's right here. Business Markets Insider here, Business Insider. Ballooning debt in the coming years will force the Fed to buy massive amounts of bonds again, according to Michael Howell, managing director at Cross Border Capital. Writing in the Financial Times on Wednesday, he predicted that the central bank will have to abandon its quantitative tightening plan, which would roll back prior stimulus by shrinking the Fed's balance sheet. Instead, the Fed will return to its quantitative easing scheme, lifting stocks in the process. Quote, investors should therefore expect a continuing tailwind from global liquidity instead of last year's severe headwinds. This should prove good for stocks, but less positive for bond investors, he said. Despite forecasts of a looming funding drain, the liquidity cycle has already passed its bottom and will trend up over the coming years, he said. Blah, 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 blah. Okay, so it goes on, and essentially what he's saying is that because the amount of debt is just going to explode because there's no spending limit, that the government's just going to have to finance it. Issue more bonds, buy the debt. Issue more bonds, buy the debt. It's possible, but honestly, will it happen? Time will tell. Let's see what some of these comments say, though. We're still near record low employment with high inflation, and we're running a bigger deficit than at the height of COVID, which was comparable to World War II spending. And we're not even really in election season yet. I don't get what's going on. We're like in full loot the treasury mode. Yes, what this guy is saying here, this commenter is, none of this makes sense. We're in clown world. We're in upside down world. That what's happening is just blatant, in your face, immoral and unethical activity. Where he says we're in full loot the treasury mode. Here's a good question: what is this money even going to? I would bet that 99% of the people that I interact with, that follow this channel, whatever, you guys probably aren't seeing any of that money directly. Like, why are the roads still terrible? Why is crime still terrible? And the police and the fire and whatnot still debating about not getting money, and all the local governments are all still strapped for cash and blah, blah, blah. All like homelessness, all of this is still happening. Where's all this money going? Nobody knows. But, um, but that's just kind of how it's gotten. I think that the social contract is so broken right now that nobody really knows what's going on, and nobody really cares either. It's just like the guy said, full loot the treasury mode. Just get what you can. If it's not bolted down, take it and just throw money. No need for any reservations when you're just giving money away in DC at this point. So, I will say one last comment. Somebody says, no one in these comments knows what they're talking about. I don't either. Neither does Michael Howell. Too few people leaving comments know economics to have any incorrect beliefs about economics. Blah, blah, blah. So, who the heck knows? Who in the world knows what's going to happen? Okay, now this was pretty crazy. If you guys saw this, now this is something with the GameStop kids, the GameStop people. I shouldn't say kids because there's a lot of very, very smart people on here. Interactive Brokers updated their user agreements. They are active starting today, which was yesterday, literally telling anyone holding this share on their books, if anyone holding shares on their books goes bust, we're left with nothing. Essentially, you would think you buy Apple stock, you own Apple stock, right? No, I'm sorry. You don't. Let me see if I can actually find where the actual, usually I put the link in here. Not today. Okay, so anyway, Interactive Brokers is now saying, hey, you bought Apple stock with us? Well, just so you know, if we go bust, we're liquidating it and you don't actually own Apple stock. And then you would say, well, hey, wait, I bought Apple stock in the account with my name. I should own it. But what 99.99% of people don't realize is every single exchange out there, whether it's Interactive Brokers or Fidelity or any of them, they're doing this thing where it's kind of like a held in name only. But a lot of people realize there's synthetic shares out there. There's all sorts of fake shares. And we found that out very quickly during the GameStop drama, that there are far more shares in circulation than actual shares that should be issued. So Interactive Brokers is just coming clean this time and just updating it on July 4th and saying, hey, just so you know, if it happens, too bad. You're not going to get your money back. We have it. It's ours. So that, I will keep an eye on this and keep bringing this up to your attention if I see more of this happening. But that is seriously concerning. I don't use Interactive Brokers. I don't know anybody who does. None of our clients do. So we'll see how this pans out. But okay, some real news here. This is kind of interesting. Goldman Sachs is looking to end its partnership with Apple. Now, if you guys didn't know, Goldman Sachs teamed up with Apple here, and they were going to finance Apple's debit card / credit card. If you remember, Apple about 2 or 3 months ago said, hey, we're going to start having our Apple Pay card that will pay like 4.5% interest, which is going to immediately destroy most all competition in that space of high yield savings or high yield checking accounts. And so that was just like 2, 3, 4 months ago. Well, Goldman Sachs is already announcing, hey, it was good, but we're done. And so here it says Goldman Sachs is going to lose over $1 billion due to its Apple partnership. It's now discussing with American Express about taking over the Apple credit card business. And they are only 2 years into a 10-year agreement. So why would they sign a 10-year agreement and then break it so soon? What do they see that no one else sees? And so, here's some interesting Let's see right here. Given yesterday's report that Goldman Sachs is looking to bail on its partnership with Apple, I thought it would be interesting to do a breakdown of the increasingly messy relationship between the two companies. After forging their partnership in 2019, Apple appears to have thrived while Goldman Sachs has suffered. Apple Card launched to the general public in August 2019, allowing users to apply for the card and check their credit lines and approve status without a hard credit check. A report a few months later revealed some early details on Goldman's investment in Apple Card. By all indications, it was a successful launch. Blah blah blah. Okay, here. While Apple Card continued to grow in popularity with over 6 million estimated cardholders, some early signs of struggle began to emerge. In May of 2022, Scott Young, a Goldman Sachs executive credited for his work on securing the Apple Card deal, left the bank. Young was a Goldman's head of partnerships in 2018, which is when Goldman and Apple reached an agreement to work together on Apple Card. Next, Goldman announced that it was facing a probe from the Consumer Financial Protection Bureau over its consumer credit card business. And that Apple Card's rapid growth and Goldman's struggle to keep up with the scale were to blame for the investigation. So anyhow, it looks like, and then finally, Goldman received far more disputes than it counted on from Apple Card customers, and it struggled to manage that growth, especially given all of the regulatory requirements that surrounded credit card disputes. Okay, so blah, 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 blah. What it's sounding like is poor old Goldman Sachs, they thought they had a good thing going and they just weren't ready, which honestly, I don't even know that I believe that, because it's Goldman Sachs and Apple, two of the biggest titans in their respective industries, and you're telling me that Goldman Sachs couldn't keep up with this. So, however, that's not it, because then a lot of people are talking about man, somebody had in here a really good chart. I'm looking through the comments right now. Somebody had a really good comment about how Goldman Sachs is trying to get out of consumer credit altogether and not issue any consumer debt at all. So whatever, I'm not gonna be able to find it for you, but that so it looks like Apple's winning the deal here. Goldman Sachs is backing out, and they're trying to. Here's the other thing: if it's a hot, steamy pile of garbage, why would American Express even take that deal? So those of you that own American Express stock, hope that if it's that bad of a deal, that they do not accept and do not say yes. So. Anyhow, that's what's going on with Goldman Sachs and Apple. It looked like a great deal, but it looks like it's maybe falling apart. So anyhow, let's move on to the next topic here. Okay, now you guys, can I even pull this? I have Saudi. Hang on. This is what this. You probably didn't see this, and it's not you. It's just that a lot of this stuff is being released strategically, like on a weekend or something when nobody is watching. So Bank of America could be faced. Do you remember all these banks? Let me start like this. Do you remember all those banks this year that have gone under because they held various fixed assets like bonds and stuff like that that were underwater, totally underwater? Well, they were underwater to the tune of like single digit, excuse me, I should say triple digit millions, or maybe even single digit billions. I think one of them, even the final one, was it maybe even double digit billions, First Republic or Silicon Valley. Regardless, this came out on Sunday night, and of course nobody saw it because it's Sunday night going into July 4th weekend, which is the best time to find the juicy news headlines, because Friday night or holiday weekends is when these things get released. Cool. Look at this right here. New FDI data shows Bank of America faces $100 billion potential loss in the bond market of paper losses. Bank of America claims it's not an issue as they don't plan to sell. Sound familiar? That's because it is. Both Silicon Valley Bank and First Republic Bank collapsed for this reason. Okay, now how do I switch to the next? I don't know. Oh man, I'm just gonna have to click each of these. Okay, so you know what? I'm just gonna click them all right now, y'all. Be patient with me. I want to make sure that you can see this stuff, because this is nuts. Okay, so some background. Bank of America is bearing the cost of decisions made 3 years ago. They decided to pump the majority of $670 billion in pandemic era deposit inflows into debt markets. This was at a time when bonds were traded at historically high prices and low yields. What they're saying there is that Bank of America took all of that free COVID money that everybody got and bought a lot of bonds. Seemed like a safe bet at the time. However, as you know, interest rates being jacked up has made those bonds go upside down last year. It says here, as interest rates rise at their fastest pace in history, these bonds are facing a $109 billion in paper loss. Both Silicon Valley and First Republic collapsed for the same reason. When depositors wanted their money, they were forced to sell these bonds at a loss. It's also worth noting that the unrealized bond market losses are an industry-wide issue. Every single bank has this problem. Wall Street Journal a few months ago said that they identified a few hundred banks across America that have this identical problem. Total unrealized losses are at a record $600 billion at U.S. banks. This is well beyond the peak of $75 billion in 2008. Comparing Bank of America to other large banks, their $100 billion in paper losses are far larger. Below is a current unrealized bond loss by bank. JPM has $37 billion in paper losses. Wells Fargo has 42. Citi and Morgan Stanley combined are at 34. Let's zoom in. Oops. Gosh, how do I... Oh, there we go. So I'm not sure if you guys can see this. There we go. So yeah, we've got all sorts of bank here. JP Morgan, let's see if there's any we realize. First Citizen, Citibank, United, US Bank, they have 10 billion, still smaller than Citibank, smaller than JP Morgan. Bank of New York, you could probably recognize that, 6 billion. UMB Bank, that's a Kansas City bank, 500 million. First Hawaiian, Morgan Stanley. Here's Charles Schwab. They've got 14 billion, still smaller than all the other big guys, much smaller than JP Morgan. But just to illustrate, okay? Continuing, an interesting comparison between Bank of America and JP Morgan stands out. While Bank of America's CEO was nonchalant about capital allocation, JP Morgan's CEO was not. Jamie Dimon was very reluctant to move excess cash into low-yielding treasuries back in 2020 and 2021. JP Morgan and Bank of America have handled this issue differently. The performance of the two banks' equity reflects the thinking accordingly. During the last 12 months, JPM stock is up almost 30% as compared to a loss of approximately 8% for Bank of America. Keep in mind, JP Morgan, if this is all true, what they're saying here, JP Morgan has been buying up these banks that are going bankrupt for pennies on the dollar, washing all their debt off on taxpayers and keeping all of their good assets, making themselves even more powerful. So that can be very much why that's happening and why JP Morgan is in a position to buy these banks. Okay, continuing. Building on this, the $100 billion in loss don't account for credit, which the bank only made $930 million of provisions in the last quarter. This amounts to a total of $14 billion of credit loss provision for the quarter. But here's where it gets interesting. These provisions seem low. As of March 31st, Bank of America held $1 trillion of loans and leases. Hence, the bank only expects to book losses on 1% of them. But that seems very low. What he's saying there is all of the credit, whether it's credit card debts or home loans or student loans or business loans, whatever, they are expecting and budgeting to only have 1.3% of people go upside down on them and go bankrupt. But that does seem very low. It says even as bankruptcies are rising, Bank of America assumes credit losses will remain minimal. Even if a borrower doesn't meet the payments, Bank of America considers a loan performing if they foresee modifying a loan terms will enable the borrower to pay. In other words, they think if the borrower will pay the future based on terms up in the air, the loan is performing, which wouldn't you love? Wouldn't you love to have that type of logic play out when you go to the bank for a loan? Hey, look, I've got this, I need a home loan for a house that's like way out of it's a 5-bedroom mansion, it's a 10-bedroom mansion. And, as long as I get a 50% pay raise for the next 10 years, no problem. This loan will perform. That's kind of what Bank of America, that's kind of the logic they're using. Continuing, the hope here is that Bank of America will never have to realize these $100 billion in losses. But what if they do? None of the recent bank collapses is expected to face the problems that they did. A system built on a contingency so severe is dangerous. Only time will tell if industry-wide losses in bonds will come with more bank failures. However, it's clear something needs to change. As rates rise, so do these paper losses. So how do we even get to this point? It kind of goes to that last article about we're in full loot the treasury mode, where people who have been committing crimes, financial crimes, in the banking and finance industry for so long, it just comes with the territory now. They budget it into their annual budget. Same with the pharmaceutical industry, same with the labor, same with the agriculture industry, Monsanto or what have you. Same with, it seems like every industry is behaving this way. But it's I don't know what to make of it, honestly. You just kind of hope, you hold on, kind of like when you're on a roller coaster and you're nearing the top of the roller coaster and you just start to brace yourself because there's no getting out of this. If Bank of America were to get called, if they were to have the same Silicon Valley Bank type of run on their bank, this thing could go bad and go sour on them in a week. So anyhow, time will tell what's going to happen. I can't tell you. I really couldn't tell. Honestly, what will happen is probably what happens every time, you guys. Truly, is it's the Fed will bail them out, print money, absorb all, you and I, the taxpayers will take the losses, and Bank of America would probably get absorbed into J.P. Morgan or one of the others. No kidding, because that's just how it goes. And I honestly would not be surprised if this is the long play for J.P. Morgan. They're a ruthless, cunning bank. They've pulled this kind of stuff off before, and they're there to play for keeps. They're not there to play for play kind. But time will tell. Warren Buffett, he issued Bank of America a personal loan to avoid default back in 2008. So something like that could happen. But anyway, time will tell. So let me take you on to this next article here. Real quick, though, before we go into that, let's see what's happening in CNBC.
Blockbuster, record-breaking results with that momentum rolling through the first half of this year. But analysts say they're just beginning to see some softening in high-end leisure travel. In Las Vegas, though, international travel and convention business has not fully rebounded from the pandemic lows. Plus, F1 is expected to result in the best November ever. That could provide some steam, especially for Caesars and MGM. And then Macau this week just posted gaming revenue for June 5 times higher than last year, but still off almost 40% from 2019. So that leaves a lot of room for improvement for MGM and
Macau is in China, for those of you who don't know.
Secondly, you're going to want to watch for IPOs and public listings. FanDuel's parent, Flutter, is hoping to engage its all-important U.S. customer base and a little stock investing when it lists here later this year. And now that the IPO freeze seems to be thawing, industry insiders are watching to see if maybe Fanatics or other smaller operators.
Okay, so nothing too interesting at the moment. Hey, shout out to Brian in the comments. I'm going to reply real quick to Brian. You guys don't forget, you guys can follow me online here, and while we are live, you can leave whatever comments you may want, and I will definitely interact. Bring up some stock questions, some economic questions, some articles that you heard recently, and we'll break them down and see what kind of stuff we can pull out of it. So,
sure, more consolidation is coming, guys.
Blood sport. That was the way you just...
Okay, well, we'll see how Las Vegas and all that performs. Quite a good indicator on how the overall economy is going when people are throwing massive conventions in Las Vegas and then also just there for travel. But okay, you guys, check this out. I forgot to do an article on this one, so shame on me. This is from a few weeks ago, back in at the end of May. Home buyers will now be able to put down as little as 1% on their mortgage, for their home. Rocket Mortgage says. So let me see where's this article? I have to find this article. Of course, this is what happens. In fact, I'm just gonna cut this for a second on the end. Rocket Mortgage 1%. News. Oh wait, here we go. So usually Yahoo Finance is pretty decent. Okay, you guys, get ready for this. This is amazing. So this came across like 4 or 5 weeks ago. Wall Street Silver says, I've seen this episode. Now they just package up those and sell them as a nice AAA batch of loans to pension funds, as if pension funds weren't already having their back up against the wall. Homebuyers will now be able to put down as little as 1% on their home, Rocket Mortgage says. All right, let's read this from Yahoo Finance. Lending giant Rocket Mortgage rolled out a 1% down, no insurance fee home loan program, aims to target more than 90 million U.S. borrowers. Is this 2008 all over again? 90 million, that would be like, if the United States is 300 million people and we assume that all 300 million of them are searching for loans, that would be a third of America. But let's just pretend half of them. So they're trying to get like half of all. I don't even know. I don't even know how to break down that 90 million number. The housing sector continues to be one of the hardest places for Americans to break into these days. Soaring prices coupled with increased interest rates, blah, 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 blah. But take me right to the meat of it. So here we go. Rocket Mortgage announced May 22 that it was introducing a 1% down home loan program. The new loan, called One Plus, also includes Rocket Mortgage insurance at no cost to the home buyer, Rocket Mortgage said in a statement, and could save more than 90 million Americans thousands of dollars. The new 1% mortgage targets low to moderate income earning Americans. Perfect. No risk there. Borrowers would make a 1% down payment, with Rocket Mortgage covering the remaining 2% for the threshold for conventional loans. The program also eliminates monthly mortgage insurance fees, which are usually applied if a buyer places down a payment less than 20% of the purchase price. I see nothing that could go wrong here. This definitely is not right out of the playbook of the 2008 collapse. Not at all. Oh, this was the fun part of it too. In a similar move, gosh darn it, United Wholesale Mortgage announced on May 24th, 2 days later, that it was expanding its conventional 1% down payment assistance program, launched in April, where borrowers could make a 1% down payment with UWM covering an additional 2% up to $4,000. Oh my gosh. I don't even need to keep going through this article. I think you guys understand enough of what's going on here, that this is going to start to fall apart. Now, obviously, Walters insists his company's requirement borrowers meet specific credit standards acts as a safeguard against the same pitfalls. We're not reducing the qualifications and putting people into loans they can't afford. While a program like this isn't going to solve the supply problem in America, it does level up the folks who are really struggling in a market that's often competitive, blah, blah, blah. Yeah, of course he's saying that. But wait until the activists come in and then force you and say that you're discriminating. Or just wait simply until the market kind of shifts and finds a new equilibrium, and the people that you said were solvent and good borrowers, turn into my house is no longer worth this much, or inflation continues rising. There are all sorts of factors that could blow this thing up. And like, let me tell you, I'm one of the first to say I hate how the housing industry works right now. It's so stinking difficult to afford a house for a lot of people who are, I don't know, maybe like 30s and younger. Especially when I look around my neighborhood and I see houses that 20 years ago were maybe $100,000 house, but now today are a $450,000 house. And you think to yourself, what in the how does this even, obviously, we know inflation, economics, blah blah blah, but like, how does this even happen? So wait until, though, as we're seeing, as CNBC was just showing, let's see, no, they're not showing, but the number of the house, the building, the home home supply, the home sales, and value of homes, all these various data points in the housing industry are starting to slowly trickle down. Now, new home builds, those are still going pretty strong, because essentially people are, I would imagine, I'm speculating here, people are not selling their home because they know that if they have to sell their home and buy a new home, that homes are just like way too expensive to, with an interest rate. Most everybody has, over the last 10 years, has a home interest rate somewhere in like the 2s or the 3s. Now you're up in the 7s and 8s. Why would you sell a house? Just hold on a little longer. So a lot of people are either renting or doing a new build and buying a new build. But whatever, you guys, time will tell. Watch this one closely. I have a feeling that since Rocket Mortgage, and let's just pull up their stock here, Rocket Mortgage is a publicly traded company. So I have a feeling that if things start to go bad, is it RKT? Rocket Lab. I believe it's, hang on. I believe it's this is them, right? Yes, right. Okay, so this is them. Let's have a look at their financials. Since they're a publicly traded company, if they do this program and things do start to go bad for them, you ought to expect to hear these updates of the number of defaults and whatnot on this program. And if you start to hear the number of defaults ticking upwards, then I think you got a real problem to be concerned about. But, you know, honestly, and then let me go to, is that even their symbol, RKT? The other part of this whole thing is this could be isolated depending on how many loans they put. If they reach all 90 million, watch out, where this is systemic. But if they only do, you know, a couple million of these type, then it could be not as bad. Let me see. Is this, what's their symbol? No, this was it. Okay, so I guess Rocket is rather new on this. But anyway, I'm not going to look at this. This is irrelevant. So anyway, watch out, you guys. Keep an eye on this. I definitely will, and I'll give you updates if this keeps developing. So let's check CNBC one more time before I show you an interview I just had regarding Costco and Walmart.
And there's a lot of people think commercial real estate is a bit overdone, Carl, and certain sectors of that can be very good for people. We're going to be talking to Todd Sohn, the head of technical trading and analysis for Strategas at ETF Edge, 1:10 p.m. Eastern Time. And the question here, Carl, is can we get a little more interest in broad equities and broad investing? It sure does not look like investors bought into that big trade in the first half of the year.
Really interesting ideas for the next 6 months, Bob. Thanks, our Bob Pisani. Our next guest is raising his Q2 real GDP forecast from 1 to 2 and sees a 75% chance of a so-called soft landing. Yardeni Research President Ed Yardeni joins us this morning. Ed, it's great to have you back. Hope you had a great fourth. You've been on fire lately talking about rolling expansions instead of rolling recessions. Can you talk about how your views have evolved in the last, say, month or two?
Yeah, well, you know, since early last year, we've been arguing that we are in a recession. It just happens to be a rolling recession, and it's hit housing, it's hit the goods sector. I think it's.
So let's hear for a minute what this guy has to say. He says we're currently in a recession, and it's a rolling recession. Let's hear him out for a minute.
Show like something like a bottom, and maybe even a recovery. We're seeing that in the housing industry as demand outstrips supply. We're starting to see, I think, a bottoming in the goods sector and the manufacturing sector. Didn't see it in the PMI, but we're seeing it in the regional PMIs. So I think there's some evidence that consumers that had kind of pivoted away from goods to services may be looking for goods again, as particularly automobiles, where the sales have been surprisingly
anyway,
strong.
This guy had his chance. I'm bored as heck listening to him. Let me show you this, though, y'all. So last week, I got to have a pretty cool conversation with Bill Zettler. He is a Seeking Alpha analyst, and he's got some really great articles, about 350. He's been doing this a long time. And let's have a look here because I got to talk to him. Many of our clients know very well Walmart versus Costco. And we were talking about dividends. You know, our dividend investors, it's always kind of a toss-up between, well, do you want stock growth or big dividends? Well, could you get some stock growth with dividends? Well, what about dividend growth? Will your dividends grow at the same? So anyway, I'm going to hit play on this. I want to let you listen to this interview we did. It's only a few minutes long, and I really enjoyed this. So here we go. All right, everybody. Good morning. I am here with Bill Zettler, and Bill has written an article on Seeking Alpha. This is part of our Seeking Alpha interview series. This actually has to do with two stocks that a lot of our clients know and like. We're going to be talking about, let me switch over there, Costco versus Walmart. If you're into dividends, which one should you consider most? Now, after I read this article, I kind of went back and compared some of my own notes, and I've got my own opinions on this, but I really like some of the stuff that Bill has put on here. So I thought I would send him a message, and he thought it would be a fun idea. So Bill, thanks for being here today. And why don't you start off for folks who haven't read this? What's the overview of what you came up here with Costco versus Walmart?
Well, we're looking at two companies that are basically do the same thing, and both have been pretty successful in the last few years. Walmart was, of course, a dividend aristocrat, so I look at those a lot. And I thought it'd be interesting to compare the two. I honestly thought that I would come out liking Costco better, but it turns out I like Walmart better. But Costco's good too.
And I think if I'll scroll down to the very bottom here, I think I know why. Why is it that you decided you actually like Walmart better? I believe here down in the conclusion, you mentioned that even though, and I'll show it right here, even though Costco, when I look at their earnings per share right here and their nice increase in dividends with those special dividends.
Yeah, those are nice.
If I remember right, you had said that when it comes to, oops, I guess Walmart got taken off. When it comes to Walmart, you liked that their dividends, correct. Why was it you said you chose Walmart over Costco at the end?
Well, one of the reasons was not the dividend, but mainly that they spent more money buying back shares than they did upping the dividend. And Costco chose to increase dividends or give those special dividends instead of buying shares back. So I kind of like the share buyback thing.
Okay.
That's a big reason.
And for those who don't know at home, share buybacks typically result in an increase in the share value. So is that kind of part of the process that went into your logic there?
Exactly right. You can spend the money on dividends. You can give shareholders dividends, or you can give them fewer shares and increase the capital value theoretically of their holdings.
Okay. And the other thing you had mentioned about Walmart was versus Costco is even though Costco does have a good history, you know, it's tough to argue where Walmart has, and in fact, let me pull it up here. Walmart has, I think you said, what is it, a 40-year history of dividends here?
Yes.
Yeah, I'll see here all the way back to 1974. Yeah, very interesting. So, you know, one of the things about Costco, Bill, did you now, granted, this isn't so much with dividends. How do you value Walmart versus Costco when you're looking at their revenue stream, where it looks like Costco is really killing it on their subscription model, if you will, their membership subscription model versus Walmart, which is still just kind of a traditional retailer? How do you think that those are going to affect any performance in these companies going forward?
Well, you know that Walmart has just recently started their $39 annual fee, and they'll ship everything for free. So it's kind of like the Amazon model.
Okay.
So that's going to be a plus. And of course, Walmart is the second biggest online retailer next to Amazon in the US. And they also have significantly higher gross margins, which I was surprised at. So the gross margins is an important item for me. I always look at that.
Okay. Yeah, I have heard that Costco, and I've seen this in their various shareholder quarterly present slideshows, that their margins are a little thinner because they prefer to get the highest quality, whatever product it is they're selling, whether it's a chips or a lamp or whatever it might be. And from what I've ever heard, and my wife included, she says, I've never, ever bought anything at Costco that wasn't just amazing. So perhaps that they're
I've heard
giving up a
people
little
say
bit
that
on the
too.
profit margin there.
Yeah, but it does hurt the margins, and whether that's a long-term issue or not, I'm not sure. But I look at that all the time.
Okay. Okay. Now, one other thing you had mentioned here, let me find it as I was scrolling through this article. Well, yes. Okay. So you had mentioned, and I'll click back over right here. Costco is increasing its dividend faster than Walmart. Do you think, in your opinion, which is more sustainable, a long-term share buyback program that Walmart is doing, or increasing dividends, which Costco seems to be doing?
Well, you get a little bit of both with Walmart, and I've always liked the share buyback. I like the decreasing the share buyback, and with Walmart, you get an increasing dividend every year, not as much as Costco probably, especially with those outrageous special dividends. I mean, that would be fun to get that check, but
Seriously.
long term, ever increasing dividend and ever fewer shares is a powerful draw for me personally.
Mm-hmm. Yeah, and just pure speculation when you mentioned that special dividend here from Costco. Not that you can ever predict it, but if you were going to try to predict one, they had it in 2012, 3 years later, 2 years later, 3 years later. So, Costco shareholders, again, totally speculating, but you might be in store for a special dividend if they can keep things going smoothly in the next, say, year to year and a half. But,
Yeah, you absolutely should. And man, that $10 one, that was something.
yeah, right. Yeah, unreal, especially if you are reinvesting your dividends.
Yeah, if you're in a drip, that's great.
Yeah, absolutely. Okay, one other question I like to ask people. Well, in fact, before I get to that one, you and I briefly talked about beforehand, Walmart de Mexico. Let me just pull up Walmart de Mexico on here. What insights have you got on Walmart de Mexico?
There's not a whole lot of information on them. I bet your organization being in early probably knows a lot more about it than I do. But I looked at it because I was curious of how it compared to Walmart.
Mm-hmm.
But it's difficult to analyze the data because, it's in Mexico and there's some different things in there. And there's very few followers. As a writer, you're not going to make any money writing about them.
Well, as a writer, it might be one of those what they call long tail articles where you write it today, and then maybe a year people start to actually realize here's a few data, some visuals.
Yeah, I know.
If you're
It
looking
looks
at my
great.
screen here, so you can see this is a 10-year, or technically 9, but 10-year revenue up and to the right, their EBITDA up and to the right.
Yeah, you like the EBITDA.
Yeah, for sure. Earnings per
The
share.
EPS is a little
Mm-hmm.
up and down, but
yep, right. But when you zoom
generally
out,
up.
still up and to the right. And
Yep.
it's and now I don't know exactly what happened with their dividends here.
Yeah, how
But
about that?
yeah, so
The
I
other
don't know.
thing with dividends on foreign companies, you got the exchange issue, and I'm sure that's not it, but that's
Yeah,
always a concern, up or down on a given year.
yeah, I should look in. I actually do not know why they dropped it so much, but again, nice to see so much cash on hand. So but yeah, it's an interesting angle, and I'll be interested if you ever do decide. You let me know. You send me an email, and I'll absolutely reach out to you quickly, and we'll do a little video on it. Just because, like I said,
Okay.
that's been one that our clients, quite a few of our oldest clients, have had for a long time.
Well, now you got me curious. Maybe I'll take another look at it.
Yeah, and I'll just pull it up here just out of curiosity. Here's this, and then we'll compare it just purely on stock performance over the 5 years. So it goes hand in hand, as you can see, with Walmart stock.
Yeah.
If you zoom, see, it doesn't even work very well, but just over the last 5 years, it compares. But so anyhow, okay, so one more question I had for you, and I love asking people this on the Seeking Alpha interviews. So Seeking Alpha used to be kind of a wild, wild west platform for authors, especially with the comments section.
Yes.
And have you found when you're writing, or specifically on this one, now I know you didn't have hundreds of comments, but did you see anything in the comments section that added to your opinion of these two, or made you change your opinion of these two?
No, and what I've noticed on Seeking Alpha, and everybody has, we're getting fewer and fewer comments compared to 3 years ago. 3 years ago, I got 500 comments on an Exxon article. And, now I just wrote one on Apple, I'll probably get 10. So
why do you think that is?
I don't know. I don't know whether people are just not commenting as often as they used to, or whether there's a filter that Seeking Alpha put up. Everybody, a lot of writers complain, that people criticize them and, blah, blah, blah. But I don't know why. It's way down now, way down.
Yeah, the comment sections can really be brutal. I was reading one the other day. A lady was writing about Tesla, and she wasn't writing good things about Tesla.
Yeah.
And the comment section was just destroying her. And like her criticisms were fair, but yeah, I'm curious if the reason that the comment sections have gone down so much, about 3 or 4 years ago, a lot of websites, Yahoo Finance, disabled the comment section, although I think they've kind of put it back on recently. A lot of other blogs that I would follow just totally disabled the comments out of fear that they would be held liable for what was put in the comments.
Yeah, some of them were so ugly that it became purposeless to read a lot of them. It's just,
Okay. Now, last question here, Bill. Maybe one of the last questions. When it comes to Costco and Walmart, do you own Costco and or Walmart?
No, I do not own either one.
Okay, cool. So you're pretty neutral on this. Okay, very nice. The only other things I can say when I think about Walmart versus Costco is when I read, and for some reason, Costco is a stock that I watch closely, and I like to read their quarterly reports and watch their slideshow. I know that they are expanding into other countries right now. They're going very, very slowly. I think it was Japan and maybe Korea that they have just recently gotten into in the last year or so. And they have said very clearly, and in fact, I'll pull this up one more time. You can see they said, we are very conservative. We are proud. Let me get back to Costco. Yeah, Costco. They say we are extremely conservative on how we're running our company. And we are very proud of that. And we are in no rush to open new stores. You had mentioned how many stores Walmart has versus Costco. And
Yeah, there's
management
10,000 or something, and Costco has what, 700 or
Yeah, right. Like not even near what Walmart has. But
yeah.
this is it's very clear in their management style when you look at some of these things
Yep.
that Costco's and they say it almost every single quarterly presentation. We're extremely conservative. We're in no rush to be the biggest. We want every store to be perfect. And now, since we are expanding into other countries, we want to make sure that before we just start flooding the market, that we can actually make it work well. So it'll be interesting to see.
I would call that a real plus, and I also would say Japan and Korea would be probably two very good ones to go into.
Yeah, absolutely.
I
So
think
yeah,
that's
they're
a good
very,
idea.
very much so. Time will tell, but you know what, Bill, I appreciate you making time. Anything that I missed on this conversation that you wanted to mention?
No, I think we covered it pretty good, Ryan. Thank
Very
you.
cool. Well, I appreciate you making time today. People at home, if you're curious about Walmart or Costco, reach out to me. Here, let me show you. Here is, if you want to follow, here is Bill's author profile. You can find him on Seeking Alpha as an analyst since 2015, going on 8 years right now. So,
Wow.
and how many? Let's see. You got 350 different articles you've written. So, you guys, if you like what we're talking about, find Bill on Seeking Alpha. Reach out to me. Reach out to him. But that's all we've got for you right now. Thank you very much, and we'll see you on our next broadcast. See you guys. Okay, so that is what I've got for you on Costco versus Walmart. I hope you found that to be somewhat interesting, and big shout out to Bill. Thank you for making time, Bill. That was a really fun conversation because he actually kind of enlightened me to kind of make me reconsider my position on Walmart versus Costco. So anyhow, you guys, let me go back real quick. Let's just do one last update to see what they're talking about on CNBC.
You deserve a better credit score. Chime can help no matter where you're at. Whoa. Because with everyday purchases and on-time
I
payments,
think that's about all I got for you.
things can happen a lot easier.
Whoa. Just see what the latest news this morning in the market.
Whoa.
Fast as scientists, Alzheimer's drug.
You deserve some credit.
Whoa.
Get started at chime.com.
Move to restrict.
Wall Street firms out with more top picks for the third quarter, this time out of RBC and BTIG. Dom Chu has been making his way through the alphabet there, joins us with more. Hey, Dom.
All right. Long way to go, short time to get there. So check out these picks from RBC and BTIG. First of all, we'll start off with the names Deckers Outdoor. First of all,
we're not going
if you take a look at
time on that because it's just somebody's, a faceless name who's trying to convince you of something. Rivian Automotive rallies after delivering electric vans to Amazon in Europe. Rivian had a very good week. They actually, if you look at their stock here, they had some good news this week. Up 23% this week. Paycom, Chipotle highlight Goldman's rule of 10 stock screens. Chevron, C Business. Citi says stays cautious on chips. Jeffrey, Boeing is selling a bunch of helicopters to Germany. Wayfair, DoorDash, and Chewy shine in e-commerce data check. Nothing real too exciting, you guys. Honestly, it's kind of a slow day. These half weeks, these holiday weeks are pretty boring. Moderna sets to invest $1 billion into China projects. So, anyhow, here's a big deal. Tesla smashed their quarterly earnings with the amount of deliveries they had, which was amazing for them. So anyway, you guys, let me check this real quick. Let me just check the comments with y'all. Very good. That's all I got for you guys right now. I'm going to end this stream. You guys take care, and I'll see you in the next one.